Well, just one more day and we can get back to trading again. This is silly having these holidays get in the way of our fun. As Squawk Square said this morning, Tesla will have a much better day today than it did on Friday. Yeah, this is true. Okay, let's see here. We've got data aggregated by Telestats. .NO suggests that Tesla saw 2,959 vehicles delivered in August in where? This is in Norway. This represents a notable 39% year-over-year increase compared to the 2,135 vehicles that were delivered in 2024. Estimates from EU EVs also indicated Tesla sold 2,450 Model Ys in August 2025, making it the country's top model. Tesla's domination in Norway was so noticeable that even with several days left in August, Swedish automotive outlet Car Up estimated that Tesla already held about 22% of the country's auto market. This was very, very impressive considering that Tesla saw headwinds in the rest of Europe, as pointed out by Reuters. Reuters says that Tesla sales has the rout in several European markets continued in August amid fierce competition from EV rivals and a backlash against Elon Musk, although Norway and Spain bucked the trend. Data from France on Monday down 47%, while overall market grew, or sales, total auto market grew 2.2. Staying up to date with the latest news trend. Tesla registrations fell more than 84% in Sweden. That probably had to do with shipping. Maybe, but 84% would be crazy. Where electric vehicle sales were flat and the market overall was up 6%. Sales also dropped 42% in Denmark. Tesla registrations in the Netherlands were down 50% in August. Sales in Norway and Spain rose, but growth was well below that of China's top electric car maker. BYD, Norway, where Tesla has deep roots and virtually all new cars are electric. We already talked about Norway. And Spain, which provides EV subsidies of up to 7,000 euros. Tesla's sales rose 161% to 1,431 cars. I mean, the numbers are so small. One reason we're continuing to see disappointing Tesla sales volumes can be attributed to more competitive market environment, said Matthias Schmidt, European auto markets analyst at Schmidt Automotives. But also low Tesla used car prices are a big factor. Tesla slashed the price of new cars dramatically starting in 2023, seriously undermining the value of used Teslas that are now being snapped up. So this goes back all the way to the whole craziness with COVID. So, of course, COVID created shortages, and then the shortages created very, very high prices. And then after the COVID thing was over and people had all this money and they were spending the money, but anyway, the prices, as you know, you remember the whole Hertz thing, where Hertz had to unload tens of thousands of cars because they got caught in that shift. Well, a lot of consumers got caught in that shift as well. They bought these cars at crazy prices, not just Teslas, but other cars. And apparently this person anyway believes that is impacting car sales in Europe now, in addition to all of the Chinese cars that are coming to Europe, which we're aware of that problem. And these are apparently, hurting Tesla sales. And then we've got the Elon factor, which I admit in Europe in particular, it is an issue. Now, the question becomes, why is the Elon problem not a problem in Norway and Spain, but it is in these other countries? And also, as there's a rightward shift right now, almost 100% across Europe, why wouldn't the rightward shift be starting to help in Italy, Germany, United Kingdom, etc.? You'd think that we would see some kind of a relief rally. Barron says the used car issue is also a problem for the United States. Part of the problem is the tax credit, of course. This is according to our buddy Narayan. The original $50,000 price isn't the price that most car buyers are paying. Including state and level EV initiatives, the original purchase price might have been closer to $40,000 or $42,000. And then, of course, when that goes away, then the used cars are going to seem that much better. The math, however, doesn't help makers of the EVs. Sales are going to get worse, says Narayan. Buying used is simply a better deal right now. Narayan, however, he's talking about all BEVs, by the way. Narayan, however, rates shares a buy. At Tesla shares a buy. His price target, $325, even though that is right around where we are. I don't know exactly. Where did we end up? Let me just check that real quick. So we have a handle here. 333 is where we ended up. So even though 325 would be below that, he's still saying buy, buy, buy. Most of the value in Tesla is tied up in the artificial intelligence initiatives, he says. Tesla's using AI to train cars to drive. We know all that. Before robots and the widespread adoption of self-driving cars, Tesla had to contend with EV sales. In July, Musk warned of some rough quarters ahead for the car company, partly because of reduced government support. Okay, but as I've pointed out, now with the change in the IRS information, that is no longer going to be an issue as much as we thought. Should have excellent sales in throughout the rest of this year. And then if the Model Q comes out in the United States between now and the end of the year, we should see the Model Q helping sales in Q1. And of course, last year's Q1 was a disaster, so it might not be that hard to beat Q1 this year. LiveMint.com says that South Korea's retail investors are losing faith in Tesla's a little bit, at least, ramping up their selling last month and growing disillusionment with the electric car maker amid growing disillusionment with the electric car maker and rising interest in cryptocurrencies. Individual investors in Korea sold a net 657 million of Tesla stock in August, the largest outflow since 2019, according to Bloomberg. Technology, the 1.8 billion exodus during the past 4 months signals waning enthusiasm among one of Tesla's most loyal global retail investor bases, where buying sprees once amplified the stock's rallies. Korean traders who had been drawn to high-profile U.S. tech companies such as Tesla during the COVID war are now putting their money elsewhere. So it's not just Tesla, apparently. Tesla used to offer a lot of inspiring narratives, but has failed to win people's hearts, according to Han Jun-soo, a 33-year-old individual investor who first bought Tesla stock in 2019, but sold out earlier this year to focus on names he sees having more upside. It has failed to lead with its own AI narrative. Still, Tesla remains Tesla remains the top foreign stock among Korean retail traders, who hold about $21 billion worth of company stock, according to the data. By comparison, NVIDIA and Palantir marked a distant second and third. The exchange-traded fund TSLL, which offers double leverage exposure to Tesla, also saw its biggest monthly outflow. So this would be the Korean retail investors trimming what was huge exposure, which not maybe that surprising after 5 years of going nowhere. Joe Tegmeyer says this is a brief discussion about a new CyberCab test vehicle undergoing wind tunnel testing, with numerous changes that show that this is no longer a prototype, but a first-level production test article. Also, the CyberCab production line setup is making great progress as Tesla moves closer to bringing the CyberCab reality in 2026. I think we'll see it in 2025. Later in maybe December, we'll start seeing some. Sawyer Merritt says this news: Samsung is speeding up work on their new Texas chip plant after the $16 billion Tesla deal. Tesla may invest about $2.8 billion by the end of 2026. That amount is based on producing about 17,000 wafers per month eventually in that fab. This is Randy Kirk. Please hit like, subscribe, notify. You know the drill. Join Patreon. Thank you to all the Patreon folks who are so loyal. Year after year, the loyalty is impressive. Thank you very much. Washington Post says this morning. Now, listen up. Listen up here. This is okay. Why am I doing this article? This is an article on housing. I'm doing this article on housing because I think a lot of you are 55 to 75, maybe even a little older. You are men. You are thinking about what you're going to do over the next 20 years with regard to the house you have and maybe the homes that you have that are rentals or second homes. You're thinking about it in terms of your the inheritance you're going to leave behind. And most people don't pay any attention to long-term trends, demographics, etc. This Washington Post article does, and it's interesting. And of course, I'll make commentaries as we go along. The national housing shortage, which is still there, which is in individual housing units as well as rentals, appears to be on its way out, even as the issue heats up Washington policy and media circles. We've had Trump talking about ways to get rid of the housing shortage. Over the next 5 years, estimates show that demographic shifts and a surge in construction will supply enough units to bring down prices and resolve the housing crisis. How could this be? Well, the primary reason is the United States is not one housing market. Policy experts and journalists who dominate the housing narrative tend to conflate extreme shortages in New York, Los Angeles, and San Francisco with conditions in the overall nation. This winds up overstating a real but localized problem. California alone accounts for roughly 1/3 of the shortage that people are talking about. There's a grave risk in making national policy based on local problems. In recent years, the Yes in My Backyard, known as YIMBY, has argued for changes in zoning laws to create more housing, bring down prices, encourage use of public transport. Not everybody is all in favor of those. People like the Washington Post are, but getting this crowded, housing near train tracks is not everybody's cup of tea. Yet housing affordability is shaped by more than zoning. Interest rates, construction costs, labor shortages, property taxes, large investors, all of these things play a role. So do population trends and regional demand. In Austin, for instance, rents fell 10% between 23 and 2024, and I think they're still low, or lower, in a low position after a pandemic era construction boom, but not only because of new supply. Developers overshot, thinking the city's expansion would continue forever, unabated. Instead, the city's population growth abruptly dropped to its lowest level in over 60 years. I think his growth dropped, and now Austin has excess supply. Not going to happen anywhere. Happens all the time in places like Nevada. They'll overshoot in Phoenix. We've seen it in Phoenix. We've seen it in parts of Los Angeles. We've seen southern Florida. We've seen this where they just build, and then all of a sudden they got way too much. So how will the shortage end? Well, right now, too many people are chasing too few homes occupied by the once largest generation in American history. The silver tsunami, the gradual end of the baby boomers from the housing market via downsizing, relocation, or death, could significantly narrow the national supply gap. According to a 2024 report from the Mortgage Bankers Association, more than 4 million owner-occupied homes will be vacated by 2030 because of aging. So around 1 million a year, a little less than 1 million a year. Freddie Mac estimates an even larger wave of 14 million units coming on the market over the next decade as even more baby boomers kick the bucket. New construction will add to that. About 1.6 million homes were built last year, 15.8% increase over the previous year. Even if that pace slows back down to 1.3 million, around 6.5 million new units could be completed by 2030. Add in 4 million or more homes freed up by the demographic changes, and you can see that there could be a lot, it's like 10 million additional homes coming online. At the same time, the demand side of the equation is less robust than often assumed. Immigration will only continue to bring in about 1 million permanent residents each year, which instead of the 3 million you've seen in the last few years, which using a rate of roughly 2.5 people per household translates into 400,000 households annually, about 2.4 million by 2030, which is what I've been talking about for how many months? When combined with declining birth rates and slower family formation, Randy said, demand appears to be growing steadily but not soaring. In other words, housing supply might not only catch up to demand, it might overshoot. Yes, this could happen, and this could have a significant impact on housing prices because things happen in the margin. And so all of a sudden you get a little bit of an overshoot and the prices can come down a lot because people start chasing the price. Do you know what I mean? People have their house on the market. They really want to sell. All of a sudden the prices start coming down. So they lower their price and the next door neighbor lowers their price, et cetera, et cetera. Still, risks remain. High interest rates, labor, but see, that could change too. And that would be a good thing. If the interest rates come down, that could help support the higher prices. High interest rates, labor disruptions, climate-related shocks could slow construction or reduce usable housing stock. Certain markets might still experience shortages even amid national surpluses. But a variation between metro areas is a future that we all have to pay attention to. In the national shortage advantages, what will happen to YIMBYism? Its adherents will probably pivot to arguing that there remains a shortage of the preferred type of housing, smaller, denser, more communal spaces built around walking, cycling, and public transport. But you see, I think that's all going to go away if the supply starts to overshoot the demand, then nobody's going to want these little tiny houses with no yards. These ideas carry trade-offs, and insistence on denser neighborhoods could mean land use regulations and taxes for property owners, a form of restrictive zoning unto itself. A fairly modest shift towards public transit could relieve roadways, true, but walking and cycling are not practical for many city dwellers, particularly in hotter climates. Restricting access for cars to induce public transit use might look good on paper, but in practice demands major commitment of time and energy from commuters. Okay, a lot of that is an argument back and forth. I'm sorry that I took you through all that. But yeah, to a certain extent, I'm going to agree with that, even though I'm a great, certainly a person who loves cycling and believes that it's great to have walkable, cyclable neighborhoods. I don't believe in doing it in a way that forces or coerces people to do something. But this is the basic concept is absolutely true. Market Watch has this. 𝐄𝐦𝐚𝐬𝐝𝐻, Chief Equity and Quantitative Strategist at Evercore, is positive on a correlation. In a new note published Sunday, he said Emanuel and his team describe a technological revolution that will lift stocks, multiples, and society to new highs, which is, of course, what some group of guys are putting out a book about this. It's a structural, tech-driven bull market that's been interrupted by a non-recession bear market, which has regained all-time highs very quickly, driven also by the Federal Reserve's cutting interest rates. Okay, so what we had was, of course, the 20% drop in the bear in April, which was a V-shaped recovery, like almost immediate, craziest recovery ever. Tom Lee and others are saying that this is the beginning of a bull market right now. However, that was the internet revolution he's going to compare it to, as everybody does. It's also the AI revolution bull market of today. In other words, investors have been offered a twice-in-a-lifetime technological revolution to exploit, according to Evercore. Why is Emanuel so positive about the market's current AI excitement, especially given the dramatic fall for equities after the internet bubble burst in 2000? Well, AI is bigger than the internet plan. Its effort so far has touched all parts of society and industry, even as adoption only begins to impact. While the equity market has seen broad rally participation, they believe that this was basically what he's saying is the same as what Tom Lee has been saying, that we're basically in 1997, not 1999. Indeed, he notes that in contrast to the 1990s, utilities could be well suited to have a great run because of the requirements for energy for these plants that are going up. Emanuel acknowledges that some investors are wary, and the majority of the AI-driven bull market gains have already been seen in the cycle. He disagrees, and thus introduce a year-end 2026 price target for the S&P 500 of 7,750, 27 times earnings per share estimate at the end of 2026. That's pretty wild. And this is something I've been talking about. Can we actually have a 27x PE for the market? And again, if we see productivity increases at 7% or 6%, like Cathie Wood thinks, well, then maybe. This is obviously a high multiple by historic standards, but Emmanuel notes that the previous technology revolution market in 2000 saw the S&P 500 trade at 29 times. Furthermore, just like during the internet revolution, the AI revolution is going to have an accommodating Federal Reserve to provide support. The critical difference being that in 2025-26, a Fed that is increasingly carrying President Trump's imprimatur is not going to hike rates at any time before the 2026 midterms, regardless of the economics brew, says Emmanuel. In fact, if the Fed were to overstimulate the market, then Evercore does see the risk of a bubble forming that could create a problem after the surge to 9,000 in 2026, as a multiple of 30 is applied to the earnings. So we could get above his 28 number to 30, and then we could have a bubble. To be clear, Emmanuel and his team still think the market is due for a pullback in the near term. Is a 2025 year-end price target of 6,250. So that will be coming down. He says, scares are a part of innovative-driven bull markets as their narratives are stress-tested in real time. Okay, I don't see that at all. I'm thinking I'm good with my 6,600 for the end of the year. Trueflation is at 2% overnight, 1.90 year over year, and their PCE comparative is 2.2. So all of those are solid. President's rating is at 48% this morning. And of course, we still have the GDP estimate of 3.5. I believe a new one comes out tomorrow, which I'll report on either tomorrow night or Wednesday. By the way, all of the stuff with, it's all going to be confused for the next day or so. Tonight, it will be on Monday night, we will be doing the thing I normally do on Sunday night, which is talk about all the different economic stuff that's coming up in the week. And then tomorrow night, I think we might have, and then we'll have late tonight, we'll have, instead of Brian White, who will be on Tuesday and Wednesday this week, tonight, I'm going to have Nick Gibbs. Tomorrow night, I'm going to have Larry Goldberg. I think, at least I've asked him to come on tomorrow night because Nick can't come on. All right, just a little programming update. All right, what do we actually have in terms of market information today? The only really thing we get to look at is the Bitcoin, which gives us some indication of how things are going on an off day, and it is flat at 109. So that's not giving us much information. All right, so I gave you what the setup for the next couple of days. Yesterday, I'm going to put a couple of cards up right here. I can't even remember what I did yesterday, so I can't tell you what you should, but I'll pick really good cards in case you've got time to watch them. Obviously, very, very slow yesterday in terms of people watching this stuff. It was CERN Basher and Brian Wong were the two videos I'm going to put up. And of course, they were amazing because they were CERN Basher and Brian Wong. But the Brian Wong one in particular got like so few views. So if you've got some time, there they are right there. Go check them out. It has been great talking to you.